When you have an extra $25 in your pocket, you can spend it on Amazon to buy a bathroom shower curtain, a mobile phone case, chili paste, or even this ballerina doll with a tail. But what if I told you that $25 is enough to start investing in real estate right now? Yes, you heard that right. You don't have to spend tens and thousands of dollars to make money on properties. And on top of that, there's no need to deal with the management of any real estate at all. How is that possible? Thanks to REITs, or real estate investment trusts. So what are those? How can you invest in them? And why do they offer some of the highest yields? Today, you will learn all that and much more. REITs' popularity has been growing worldwide for many decades. There were 893 listed REITs globally in 2022. Still, the US is an absolute leader, with the REITs market capitalization rising from $8.7 billion in 1990 to an impressive $1.9 trillion in 2022. Even the S&P 500 includes over 28 REITs.
REITs help house the U.S. economy by providing much of the real estate where we live, work, shop, and spend our leisure time.
American REITs own over 535,000 properties across the U.S. valued at $4.5 trillion. Even though REITs might not be as popular as stocks or bonds, they're far from being a new concept. Their creation dates back to 1960, when U.S. President Dwight Eisenhower signed a law that changed how people could invest in income-producing properties. Eisenhower wanted to promote real estate investment and encourage people to use this new instrument. This approach combined all the good things about both real estate and stocks. But the modern REIT took shape after the Tax Reform Act of 1986, allowing these trusts to do more than own or finance real estate. They could also operate and manage it. The whole idea behind REITs was to make investing in high-quality commercial real estate accessible to everyone. Over time, they have improved and refined this approach, but the goal of inclusivity has always stayed first.
Things don't last for 60 years unless they're proven to work.
Today, around 150 million Americans live in households owned by REITs, and investors from over 40 countries have access to those income-generating real estate investments.
They really have led the world.
REITs can vary a lot as they specialize in different property areas. For example, these companies can invest in apartments, office blocks, shopping centers, hotels, healthcare facilities, self-storage facilities, and data centers. This means that you also can invest in absolutely any real estate sector with any budget through REITs.
In the US REIT sector, you have a lot of different subsectors with all sorts of different exposures.
There's 16 different subsectors, so there's always some pockets of opportunity.
So not all REITs are made equal. What are the primary differences then? There are three main types of REITs. The first one is equity REITs. These are the most common ones. They own and manage income-generating real estate. Their main source of revenue comes from renting out properties. The second type of REIT is the mortgage one. These REITs lend money to real estate owners and operators. They do it through mortgages, loans, and mortgage-backed securities. They earn money mainly from the difference between what they invest and the interest payments they receive from the borrowers. And the third REIT type is hybrid. They combine the investment strategies of both equity and mortgage REITs by using a mix of owning and managing properties, as well as providing loans and investing in mortgage-backed securities. If you decide to invest in REITs, you should also know another essential characteristic when comparing different real estate investment trusts. They can be traded and non-traded. Traded REITs are the ones most people know and invest in. They are trading like regular stocks and have their ups and downs like any other market does. Whereas non-traded REITs don't openly sell on any market exchange. That's why their transparency and liquidity are limited. But the biggest advantage of non-traded REITs is their direct exposure to the real estate market without being affected by market fluctuations. The issue with investing in them is that you need to qualify as an accredited investor. But to become one, you must meet one of the three criteria. The first one is to have a net worth of over $1 million alone or with a spouse. The second one is to earn an income that exceeds $200,000 or $300,000 combined with a spouse in the past 2 years and prove your ability to sustain this income. And the third requirement is to have specific credentials, certifications, or designations recognized by FINRA, the Financial Industry Regulatory Authority. Now you understand why non-traded securities are not as popular as traded ones. But to be honest, there's no need to worry if you can't become an accredited investor, because if we compare both, non-traded securities have many disadvantages, such as stricter requirements, as you have seen so far, less transparency because non-traded REITs might not disclose their investment properties in detail. The income distribution is also unpredictable. Publicly traded REITs offer regular dividends, but non-traded REITs' income distribution depend on the board's decision. There is another issue with liquidity. It is much harder to sell non-traded REITs because they don't trade on any market exchange. And on top of that, non-traded REITs have higher fees. Considering all the potential downsides of the non-traded REITs, we won't focus on them any longer. Instead, let's see how REITs work in practice. Most of them follow a simple business model. REITs use investors' money to buy several properties. Then they rent them out and collect payments on their real estate. The rent from these properties become income, and it is paid out to investors as dividends. This cycle keeps repeating, which gives investor a steady flow of recurrent income. Sometimes, properties in the portfolio might be sold, bringing in additional cash. At the same time, mortgage REITs have a bit of a different structure. They don't own properties directly, but finance real estate and earn income from the interest on these payments. As for the dividends, there is an interesting detail that is very beneficial for those investing in REITs. By law, real estate investment trusts must follow the 90% distribution rule. It requires them to pay out at least 90% of their total income. Some even pay up to 100% of their taxable income to the shareholders. One of the many reasons why REITs have gained popularity is their impressive performance compared to stocks. Even though most people believe that the stock market offers higher returns than real estate, the data shows otherwise. As you can see, REITs have outperformed the S&P 500 over the past 20, 25, and 50-year periods. While REITs beat stocks in the long run, S&P 500 showed higher returns over the past 5 and 10-year period. Here you can also see how different REIT subgroups did compared to the S&P 500. Over the course of 27 years, from 1994 to 2021, self-storage, industrial, and residential REITs had the highest average annual returns. So we see that REITs have much higher yields than many other investments. If you get 11% yearly and reinvest all the dividends you get, you can grow your returns exponentially thanks to compound interest. I won't focus on how to leverage it now, but if you want to learn more about compound interest, feel free to check out this episode after watching this video. And now, back to REITs. How do you invest in them? Basically, you can do it in 3 steps. Open a brokerage account, pick REITs that work for you, make a purchase. Now, let's see the details you have to consider at every step of the process. To invest in traded REITs, most people open a brokerage account. It is the easiest way to buy shares of any company. To open a brokerage account, you can find a suitable platform, preferably offering low-cost options. For example, no monthly minimum, flat rate trading fees, and no minimum balances to start. On most platforms, you can transfer just a few $100 or even $25 to begin trading once your account is set up. The next step is picking the right REIT and industry to invest in. With over 225 publicly listed REITs covering various real estate sectors, it can be challenging to decide. But there are some essential factors you have to consider before making a final choice. First of all, check who's managing the REIT you want to invest your money in, because profitability and property appreciation over time depends on the manager's ability to pick the right investments. The second factor is diversification. REITs need to have a diversified portfolio in the same way as we do. And the third aspect to pay attention to is the REIT's public financial statements. There, you can check the company's profits, losses, and cash flow. This can give you a basic understanding of how healthy the trust is. After choosing the REIT you want to invest in, you proceed to purchase the shares. There's nothing complicated about this. Still, remember about diversification. Most financial experts don't recommend investing more than 10% of your investment portfolio in a single company, no matter how good it seems. Now that we know how REITs work, let's find out about their benefits and risk. Real estate investment trusts come with some great benefits, such as reduced risk and volatility in your investment portfolio, as REITs are generally considered to be much less volatile than stocks. Access to expensive real estate that is usually available only to big institutions, a steady cash flow, and to top it off, REITs can be tax-efficient investments. All this explains why about 80% of registered investment advisors recommend REITs to their clients as part of a diversified portfolio. Besides, in the US, the count of real estate investment trusts was pretty consistent lately. In 2022, there were 206 REITs, slightly less than the 217 REITs in the previous year, but it is still a significant growth compared to 1971 when there were only 34 real estate investment trusts in the US. Yet, there are risks you should know before you start. The first and biggest one is that REITs are much more reactive to changes in interest rates.
We need to think about why REITs are down so much this year.
The main factor affecting REITs' performance in 2022 was the rise of interest rates. This made it more expensive for REITs to get new debt or refinance existing ones, and acquiring new properties became expensive. As a result, financing costs increased, leading to lower REIT valuations, which in turn cause even higher financing costs. Another thing that might become a downside is taxes. You will have to pay taxes on dividends from REITs, but you should also understand that there are two types of dividends: ordinary and qualified. Ordinary dividends are taxed at your normal income rate, which are much higher compared to what qualified dividends require. And the issue is that typically, REIT dividends are not considered qualified by the IRS, which means that you will have to pay higher taxes. Apart from traditional REITs, you have another real estate investment opportunity through Fundrise. This online platform acts as a REIT. Fundrise buys, renovates, and manages different properties. It allows investors to purchase real estate shares and diversify their portfolios in the same way they do with REITs. If you decide to buy REITs through Fundrise, you should first watch this episode to learn how to navigate the platform efficiently before buying REITs through it. Did you consider investing in REITs? Share your experience in the comments to help this beautiful community, and I will see you in the next video. Bye-bye.